All right. Hello, everyone, and thank you for continuing to join us throughout the day here at the Lytham Partners 2024 Investor Select Conference. My name is Robert Blum, Managing Partner of Lytham Partners. And during this analyst roundtable, I'm excited to be joined by Ben Klieve. Ben is Senior Research Analyst from Lake Street Capital Markets, who covers the food and agribusiness sectors there. We've got sort of 15 minutes. Ben, thank you so much for jumping on here. Greatly appreciate it.
Thanks for having me, Robert.
Excellent. Let's get sort of right to it. You cover the ag sector. What is the state of the ag sector here today?
Yeah, so the state of the ag sector going into 24 here is that it's beginning to cool off, really began to cool off in 23. There was a pretty robust grain rally that started in kind of mid 2020. Basically, any ag commodity, be it corn, soybean, other grains, uh, uh, prices really began to lift starting in mid 2020, and it was a multi-year rally that began to cool here in the middle of last year. There is a lot of big macro factors behind that. Some are under the radar, some are very visible, like the Russian invasion of Ukraine. All of these dynamics have started to cool off, and so you've started to see the state of the ag sector begin to cool off after a multi-year high. Net farm income is beginning to cool off as well, but I think the state of the market is better than is feared. I think that an eventual decline from the rally over the last couple of years was expected, but going into 24, I think the ag sector is in a much healthier environment than it was, say, in 2019. So I think there's been a step change in the ag sector over the last few years, albeit a decline heading into 24.
What companies do you think are most exposed to sort of this cyclical risk that you're describing right now?
Yeah, I think cyclical risk is most pronounced for the companies that are kind of the most commoditized. These are going to be kind of the more entrenched kind of household names within the ag sector. So the bigger legacy companies that are really focused on on driving volume and without adding as much value to the farmer on a relative basis. Those are the companies that I think are the most exposed to the cyclical pressure, and that's going to span everybody from ag input companies to the large processors and meat packagers. Those really all of these kind of established leaders in the space, I think, are going to have some commodity pressure here coming into 24.
When you think about sort of technologies and farming practices, how have things evolved here over the last number of years to sort of support the next generation of agriculture, which we need to feed more mouths, fill more fuel tanks on less land and with lower carbon emissions, right? What are some of the technologies and practices that you see that are sort of next generation out there?
Yeah, so it's been really interesting over the last few years. I think there's been a lot of momentum in all these next generation inputs or production methodologies, as you noted, heading into the pandemic, and then the pandemic really, I think, accelerated the move here for all of these these products and systems. Historically, there was a lot of kind of lofty kind of environmental discussion around all of these technologies, and that is very much true. Almost every next generation ag input that I look at has a legitimate environmental benefit relative to legacy alternatives. But what's happened over the last few years is that the economic value of these products has really become much more apparent, I think. And so, you start looking at any number of these next generation products, be it more efficient chemicals that are oftentimes biological based as opposed to synthetic. Next generation seeds that are more resistant to drought, different fertilizer inputs that are bio-based as opposed to synthetic fertilizers that are produced with a huge amount of greenhouse gas emissions that have global, supply chain issues, machinery that's more autonomous or lower emission. All of these different ag inputs and machinery production methodologies, et cetera, are all, I think, really beginning to be much more apparent throughout the ag system. And I think that's only going to continue here, really, and I think be very kind of cyclically cyclically flat. No matter the state of the ag cycle, I think over the next few years, I think these inputs are all going to gain traction.
On the flip side of the question I asked earlier, sort of the companies that let's talk maybe what companies are best prepared to maybe navigate these cyclical risks today and maybe participate in this next generation of agriculture that you just described.
Yeah, so I mean the the big I don't want to understate that the big companies in the space, be it big machinery dealers like or OEMs like CNH or Deere, big ag input companies like Corteva or Syngenta, et cetera. These big companies all invest significantly in R&D with the hopes of kind of establishing the portfolio for this next generation. But I think that these big companies, the value proposition for them, that this R&D element is a fraction of their value proposition. I think there's a lot of small companies in the world of agriculture where the value proposition is almost entirely, if not entirely, built upon these next generation systems. So, I think there's a lot of companies that are bringing technologies to market that are moving towards profitability here in the next couple of years. There's an awful lot of M&A value baked into these companies, especially once they hit profitability. So these small companies are more pure play. I think long-term alpha drivers here from the current level that are overlooked by the market in a pretty significant way in sometimes. So I would definitely look to some of the smaller companies within the world of food and ag as the alpha opportunity in the space, not only in 24 but beyond.
Given some of what you just described, sort of the big guys and the sentiment within the market for them, maybe some of the smaller guys, is investor sentiment aligning with some of what you're describing there and your universe? Maybe just help people understand your universe, whether it be smaller companies, larger companies. What has the investor sentiment been towards ag and towards kind of your universe in general? And maybe how has that changed in the last 3 years as the cycle has changed?
Yeah, so investor sentiment, I would say, is mixed. There's certainly some who are looking at the at the broader kind of cooling of the ag industry that are kind of remaining on the sidelines. But I would say especially for patient capital, which I think anybody in ag should have patient capital. This is not this is not a software type business where you can flip a switch, double your revenue overnight. These are long-term plays. But for companies that are in the, I think, right position that we've talked about, there's a significant amount of long-term alpha potential, behind these, especially at the current level. And investors that have that kind of mandate, that invest for a 3 to 5 year time horizon, that have ESG mandates, the sentiment for within that collection of investors, I think remains quite high. So for investors looking for for the quick hit here in 2024, some of those are not, some of those investors are not quite as optimistic about the nature of ag. But those that have a longer time horizon and see the value proposition of these next generation, environmentally and economically sustainable companies, they I think are continuing to invest in the space.
Right. A question I've been asking a lot of the analysts here throughout the day has been sort of when you're looking to value companies and you're putting, whether it be price targets or other valuation metrics to these companies, what changes have taken place again over the last couple of years? Rising interest rates, maybe the outlook on certain sectors are less visible. The need for companies raising capital here today, right, is we all see kind of what's taking place for companies that need to raise capital. What changes have you made to sort of your valuation assumptions to account for some of these other factors out there that maybe you didn't a couple of years ago?
Yeah, I mean, certainly there's been multiple compression. There's no doubt about it. I would contend that for, I cover several, very, very profitable companies that are trading at a fraction of where they were at in 2019. And some level of compression is justifiable. But, I cover companies that were, trading 20 times PE in 2019, and they're trading at 5 times today. And their business model has only improved over the last 4 years. enterprise value to EBITDA companies in the 15 times range that are trading at 6 or 7 today. And again, they're only in a better position today than they were several years ago. So there's no doubt that there's been compression. I've had to rein in my assumed valuations accordingly. The companies that are pre-profitable, certainly they have taken it on the chin, no doubt about that. Many of which though have taken it on the chin and not necessarily needed to raise capital. There's just a fear that they will. And so there's a lot of opportunity there for companies that are actually in a good financial position, but the market doesn't believe so because of their pre-profit state. So certainly every company we've had to kind of reevaluate our price targets, some of which we've brought down significantly. Others I think are poised for some pretty significant multiple expansion here as my thesis plays out, which is that things are that the last few years have been a step change. And that a lot of these companies have much more sustainable bottom lines than is implied in the valuations.
Fantastic. We're probably got 2 or 3 more minutes. Any sort of final takeaways that you would sort of guide investors towards as they're maybe looking at this industry, they're actively involved in it? What sort of final takeaways might you provide to them and some of the things that you're talking about timeline wise are these 6 month, 12 month? What might sort of the outlook be from a time perspective?
Yeah, I mean, I think this is a really diverse industry. I mean, people talk about ag as food and ag, and I think don't really appreciate kind of the wide variability within the space. And so there's I think really compelling stocks out there. If you are looking for something over the next 6 months, over the next 5 years, if you need something that's profitable, if you're willing to look at technology based companies. There's some big trends that really are overlooked. 2023 was a phenomenal year for biofuels. Phenomenal year. That's starting to rein in a little bit, but there's a lot of opportunity still within the world of biofuels, especially next gen biofuels like renewable diesel, sustainable aviation fuel. The ag input space has gotten beaten down over the last year, given issues around destocking, and I think there's a lot of value to be had in that space as well. So I would encourage anybody to take a look at ag, because I'm sure there's a lane within the world of agriculture investing that's appropriate for pretty much any investment mandate at this point.
Perfect. Fantastic. Well, look, let's leave it there. Ben, thank you so much for your time today. Certainly a lot of informative information there, and I would encourage anyone to reach out to you if they have any questions on the ag market or any companies within his coverage universe. I'm certainly happy to make a coordinated introduction there. You can email me, Blum, BLUM, at lythampartners.com. I also want to just make note, Ben is going to be moderating a fireside chat with S&W Seed Company coming up here very shortly. So if you have an opportunity to listen into that, certainly would encourage you to do so. We also have a number of additional webcast and presentations and fireside chats coming up here throughout the day at the conference. You can visit our website, lythampartners.com/select 2024. Click on the presentations tab, which is in the top left-hand corner, and there should be hyperlinks to all the presentations throughout the day. So Ben, again, thank you so much for your time today. Greatly appreciate it.
No, thanks a lot, Robert.
Appreciate it.